Hello, my awesome accounting students. Welcome back for chapter 23.
But the key to this chapter is understanding what data is relevant and what data is what I either call noise or fluff, meaning just because some data is given to you doesn't mean we necessarily have to use it. And so the author does a pretty good job of describing the different types of costs that we're looking at. And I would encourage you guys, as you're reading through the problems, to cross out the things that we know are not relevant. And that would be things like sunk costs and circling the things that are relevant to the decision that we're making. So we're going to talk about relevant versus irrelevant costs here in just a minute. By the way, if you've had an economics class, which it's highly likely that you have, many of the definitions we're going to be talking about today, you will have seen more than once. That's the other reason why I think this chapter is not as difficult as some others. We'll look at the definitions of some of those costs. And then I listed 4 specific decisions that we'll be looking at today. There may be others, but those are the ones we're going to focus on. Whether to accept a special offer. And when I say special offer, we're talking about a selling price that's less than our normal long run selling price. And you might be saying to yourself, because I said to myself, well, it's not the first time we've done that. You're right. We have in other chapters taken a look at special offers, and we'll be following the same methodology. We'll be taking a look at a common decision, which is to make or machine a part internally versus to go out and buy it from a supplier. We'll be looking at what happens when you have defective units. Should you scrap them and sell them as scrap, or should you invest more money into reworking them to sell them at a higher price? And then this last one is sell as is. The example I use is like honey, right? When you get honey, it's raw honey. You can either sell it as it is like that, or you can process it further. You can add in different things that make it taste better. The question is, should you stop as is, or should you invest some money into it, further process it, and get more bang for your buck, so to speak? So that's where we're headed. I think the video did a pretty good job. I think the author does a pretty good job in this chapter. So I would imagine that this is not going to be a difficult chapter for you. I think today will be relatively easy. I think the second half of the chapter, which we'll talk about next week on constraints that we have placed upon us, will be the more difficult part of the chapter. So we'll go take a look at some PowerPoints in a moment, but I did want to list on this handout 5 or 6 different definitions that are going to keep coming up. And so the first one you see is a sunk cost. Okay, think about what that word sunk means. It's underwater, nothing we can do about it. So sunk costs are those costs that we've already been expended and there's nothing we can do to change them. Those are irrelevant. So as we're reading through our problems today, you're going to see me X out sunk costs. They're not relevant to the decision on what to do with this product because we've manufactured it. We've incurred the cost. There's nothing we can do to reverse those costs. So we're not going to consider them when we're choosing between 2 alternative courses of action, sometimes more than 2. Out-of-pocket costs are always relevant because they deal with future cash outlays. So any costs that's in the future that haven't been incurred yet are likely very relevant to the decision to be made. So out-of-pocket costs are almost always relevant. The part that sometimes I struggle with in both accounting classes and in economics classes are opportunity costs. And that's because they're not so well defined many times. So an opportunity cost is a potential benefit, one that you may see if you choose one alternative over the others. And when given the information, we should be considering opportunity costs. Okay, most of the time in many of these problems, they don't give us enough information to consider opportunity costs. In other words, if I am deciding to go out and buy a part versus make a part. If I were to go out and buy that part, what else could I do with that space that's left being unused right now? That's an example of an opportunity cost. And then relevant benefits, the word benefits usually denotes revenues or different monies coming our way if we make one decision over the other. Again, if it's in the future and it's incremental in nature, that would be relevant. Okay, avoidable costs are costs that we can't avoid if we choose one alternative over the other. Because they haven't been incurred yet, they are almost always relevant as well. And the last one, unavoidable costs, or sometimes you'll hear it called inescapable expenses. These are not relevant because there's nothing we can do to avoid them. So we're going to keep them out of our analysis because the number's not going to change whether we pick option A or option B. We're still going to have to incur these costs. So they are not relevant. We'll see those happen more next time when we talk about discontinuing a segment. And you might say to yourselves, oh, I think I remember talking about discontinuing a segment. And you're right. We did talk about that in another chapter. It's going to come up again in a little bit more detail. So let me go to the PowerPoint now. I think most of the definitions we will probably have looked at, but I think this is a great slide to put into your notes. So whenever we go and we make decisions, there's basically 5 tasks or 5 steps that we should consider. So number one, and most important to me personally and professionally, is I need to be able to define my task or goal in writing, right? So if I'm thinking about, should I go out? Is it time to replace my car, right? Because there comes a point where you start putting more and more repairs into something that you're going to ask yourself, is it worth my time? Write it down, define the task, and list the goal that you're trying to achieve. Step 2 is to identify alternative courses of action. Right? It might include such things as how much extra am I going to have to pay if I have to rent a car to cover me for all the time that the car is under repair. Collect all the data. And I think part of the challenge is weeding through the relevant versus the irrelevant data. Pick a course of action, right? That's probably what the toughest challenge is going to be. Decide on what's best. And then always look back at what you've done and ask yourself, did I make the right decision? And I know that I'm old enough to have made mistakes in my life. And sometimes I don't always make the right decision, but I always go back and ask myself, okay, what should I have learned from this mistake so that I don't repeat it again? Relevant costs and benefits. You already saw this definition, but this is just a reinforcement. Costs that are applicable to a particular decision, costs that should have a bearing on which alternative a manager selects, costs that are avoidable, because remember, if they're unavoidable, then they're not relevant. And again, future costs, not sunk costs that there's nothing we can do about, but most of these relevant costs will be future oriented. And then off to the side, he puts, and I hate this slide. I'm surprised I showed it to you actually, because he writes down that sunk costs should be considered. Sunk costs are not relevant. So I'm going to cross that off the slide. Out-of-pocket costs are, and opportunity costs, those are all relevant because they're yet to happen. But sunk costs, if you've already completed something, you've manufactured something, and there's nothing you can do about that cost, it is sunk. And it should not be considered. And I'll give you one of my biggest business mistakes ever, and you may have heard me talk about it, was manufacturing some spandex, which is what women wear when they play volleyball, overseas, right? And bringing them back and finding out that they were see-through spandex. The fact that I had spent, I don't even remember now, I think it was $75,000 manufacturing these spandex, it's sunk. There's nothing I can do to reverse it. I can't go back and undo the shipment that I made. It was a bad decision. I wasn't as aware of quality control issues as I should have. But the fact that I've spent that is completely irrelevant to what do I do with these now? Should I sell them at a lower price? Okay, answer to me was no, because they would still be see-through on somebody else. Or should you just go take them to the junk heap? The fact that I've spent money on them is irrelevant to what am I going to do with them now? Okay, and then the next slide I wanted to show you again is different types of costs. So sunk costs again are past. That's the reason that they're not relevant. There is something that's already happened. There's nothing we can do about it. We cannot change them. And so you're going to see me put an X through it, not because I don't want you to understand the definition. I definitely do. But just because as we're reading through these problems, we want to cross out the things that shouldn't be entering our minds. What we will be taking a look at are future outlays, things that are relevant, like out-of-pocket and opportunity costs. Okay, so one of the first things we're going to be doing, and I do believe that it's better just jump in and try these, but let's look at a couple slides anyways before we jump in. A make or buy decision. Right? This is, again, I'm not afraid to tell you guys my business failures, because sometimes failing at that magnitude makes me learn invaluable information that I probably couldn't have retrieved out of reading a text. Okay, so should I make something here or overseas, or should I buy it? Right? So the incremental costs are important. The cost to produce an item, we should be including direct materials. Okay, because of the word direct, those are directly related to producing these goods. We should be looking at direct labor, because again, if you produce it, you incur the cost. If you don't produce it, if you go outside and buy it, you don't have to incur the costs. And then here's where I think we get stuck a little bit. Only the incremental overhead. Okay, what does that mean? It means if it's a fixed cost that's being allocated to all the goods that we produced, that would not be relevant, because that overhead is going to be incurred regardless of whether we make or buy this part. So what incremental means, it's overhead that is going to change if we do go out and buy the part. So you got to watch that word incremental. Usually, but not always, it is the variable overhead. And you might be asking yourself, well, can I just put an X through fixed overhead? And the answer is no. If the fixed overhead is some overhead that you need to incur in order to make the part, then that would be relevant. So we want to take special looks at the overhead. Variable overhead is almost always included. Fixed overhead is included if it's considered incremental overhead, or it's something that we have to incur because of the decision that we're going to make. We should not use the predetermined overhead rate to determine product costs in this type of a decision. These are outside that kind of normal scope of operations. Questions on that? Okay, so here's their example of a make or buy. And it says that they currently make part 417. They assign labor at 100% of the direct labor costs. So here's what they would be taking a look at if they were looking at, again, this true GAAP basis. They make this part for $1.45. You'll notice that they are using that 100% of direct labor cost allocation. That means labor and overhead is equal. However, the correct way to look at it would be to look at the materials and the labor, but only look at the incremental part of the overhead that would be necessary to make it, not the 100% burden that they're sharing with all the other products that they make, but just the incremental overhead. And based on this slide, it looks like we could make the part cheaper than we could buy it. And then they'll talk to you also in the book about incremental costs and getting rid of specific types of overhead. And then the better part the better way to learn this chapter is to dive in and do them. So I'm going to look at one more slide with you, and then we'll jump in and we'll try these. To sell as is or to process further. And again, I use that example of honey because I was watching a show last night that dealt with honey, and it was a business show. And they were talking about whether they should just sell this honey in its rawest form, like literally right out of the beehive, and there is a market for that, or whether they should process it further and put, lavender was some of the things they added to it and all these other health benefits. And they were saying that if they did that, they could sell it at a much marked up price. So we would be looking at this from a profitable standpoint by looking at the incremental costs of processing it further and comparing it to the cost or the revenue of just selling it now. So let's read through this and make sure we understand. It says they have 40,000 units of partially finished product. The processing costs to date are 30,000. Okay, now to me, that 30,000, without reading any further, that sounds like a sunk cost to me. They've already made it. So their decision to either sell it as is or process it further should be looking at the revenues they can get from that, as opposed to the net revenues from processing it further. So let's keep reading. Those 40,000 unfinished units can be sold as is for 50. Okay, that's relevant. That's one of my choices. If I'm going to stop right now and sell it as is, I'm going to bring in 50,000. Or they can process it further into 3 other different products. And again, on that honey, I'm thinking of, honey with lavender, or honey with this other herb, and honey with something else added to it. They could process it further, and that would cost, because it hasn't been done yet, that would cost an additional 80, but would yield revenues of 150. Okay, so when I look at this, I'm looking at that brings in a net of 70,000 versus revenue of 50,000. Which would you rather have? Well, you get 20,000 more from processing it further. So let's see what their answer is going to look like. So sell as is, they're going to bring in 50. Process further, they're going to bring in 70. If you could choose one, it looks like we would choose the process further option. You notice how that sunk cost did not come into play because it's already happened and there's nothing they can do to change it. And these examples, there's no one right way to present your answer. They tend to make 2 columns, one for one option, one for the other. You could also do it in a vertical format. The thing we're looking for is, do you understand the logic? So any questions on just that short little mini lecture on what the chapter covers before we jump in? Alrighty, let's go pick up our Excel spreadsheet. And let me get to the beginning. It's like I was looking at the last problem. And here we go with a make or buy problem.
There is no one right way to do this. We want to focus on determining what information is relevant to the decision to be made. And we want to cross out any data that is not relevant. I think that will be the toughest part of the chapter. And if you can do that, I don't think you'll have any problems making the right decisions or coming to the right conclusions. So we notice that this is a make or buy, a very common business decision that is made in manufacturers. Beto Company pays $2.50 per unit to buy a part for one of the products it manufactures. So right off the bat, they gave us some relevant data. Right now, they go outside and they pay $2.50 per unit. So one choice would be to continue buying the part from that distributor. With the excess capacity, the company is considering making the part. Okay, stop. One thing that needs to be in place when you decide to make a part is that you have the capacity to actually make it. If your manufacturing floor is 100% taken up with other profit-making items, then this wouldn't even be an alternative. So the reason that they mention capacity here is so that you know that the manufacturing entity has the space to make the part. So the other alternative on making the part would cost $1.20 for direct materials, always relevant, $1 for direct labor, always relevant, and then we always got to watch out on the overhead because the overhead tends to be a mixture of well, definitely indirect costs, but some are variable, some are fixed, some of it might be allocated. So we got to read further to find out what is in that overhead mix. It says the company normally applies overhead at the predetermined rate of 200% of direct labor cost. That's their gap costing. That's the amount they're charging out overhead. However, the next sentence says incremental overhead to make the part. Just the overhead related to making this part would be 80% of direct labor costs. So for this analysis, we're going to throw out the 200% because there's lots of different cost allocations in there. And instead, we're going to focus on the incremental analysis. So the question is, should we make or buy the part? And they want you to prepare a model. Okay, the easiest place is where I usually start. So the easiest option is to buy the part, to go outside and to buy it from a supplier, because that's one number. Basically, they gave that to you in the first sentence. That was $2.50. The more challenging part is to make, okay, and again, you have to have excess capacity, and they mentioned that they do have the capacity. So to make that would cost them direct materials, direct labor, and just the incremental part of that overhead. So I'm just copying over the data given. The author said it's $1.20 for the materials, it's $1 for the direct labor, and then the more challenging part, and I'll put that out here in a little notation, it was 80% of direct labor cost. So 80% of direct labor would be the incremental part. You can probably do that in your head. That would be 80 cents. I'm going to foot those or add them up. So let me put an underline here. Let me call this total cost to make. And when I add those up, we get $3. Now this would be cash going out. And so you got to watch these. Some involve money coming in, some involve money going out. If it's money going out, we're looking for the cheapest possible options with all other things being equal. The correct answer would be to buy from supplier because it's cheaper. And in your final answer, especially if you are doing this by hand on a piece of paper, make sure you let the user know which option you are recommending. So I'm going to call this cost savings to buy the part, and that would save us 50 cents. And I'm going to make sure that I recognize that is per part. And again, include your answer in the last line of the problem so there's no question about what the correct answer would be. So let's go back and make sure that we answered what the author asked us. Letter A says prepare a make or buy analysis. We've done that. And then letter B, they're just once again making sure that you understand what the correct decision would be. The Gilberto, I guess is the name of this company. Gilberto should buy the part and save 50 cents per part. Okay, on to the next. Here's another make or buy question. Since it's very similar to what we've just completed, go ahead and read the problem, pause the video, and we'll go over the answer after you complete yours. Okay, this time I started it off with the make option, just to let you know that there is no one right answer on how to set these up. Since I started off with the easy answer last time, I thought this time I'd start off with the more difficult one. So to make the part, it costs $1.20 for direct materials, always relevant, 75 cents for direct labor, always relevant, and then incremental overhead of $1.40. They didn't throw us any curveballs on this one. They let us know right off the bat what the incremental overhead was, so we summed those up. We found out that it was $3.35 to make it. The other option was going out on the open market and buying the part for $3.50. On the screen, you'll see the comparison of the two. You'll notice that I emphasize the correct answer in my last line. And in this case, we save 15 cents a part if we made it in-house. Again, you've heard me tell you my business failure stories. Other non-financial factors should be considered. For example, will the quality be up to par? When you make it in-house, will there be proper quality controls? Other things to consider. If you make it, are you polluting the environment? There's so-called green factors that should be considered. Do you have the expertise to run whatever machines it is in-house? If the correct answer was to go out and buy the part, you may want to consider, what's that going to do to the workers in your factory? Will it be necessary to lay off workers? So there's human considerations. So accountants many times get criticized for being bean counters and just focusing on the financial factors. In going over this problem, I just want you guys to start thinking about other non-financial factors that may come into play. Okay, that one was fairly easy. On to the next. In this example, we'll take a look at whether to sell something that has been made as is, or whether to process it further in the hopes of bringing in more income. This one says Kobe Company has manufactured 200 partially finished cabinets at a cost of $50,000. That $50,000 is a sunk cost. Cabinets have been manufactured. There's nothing else we could do to reverse that cost. Put an X through that cost as it is sunk. There's nothing you can do to change that cost, and it has nothing to do with the two options of whether to sell as is or process further. So X out those sunk costs. These can be sold as is for $60,000. Okay, that's one of the choices. If you sell them as is, you're going to bring in revenue of $60,000. Instead of that alternative, the cabinets can be stained and fitted with hardware to make them finished cabinets. Further processing costs would be $12,000, and the finished cabinets could be sold for $80,000. Okay, those are incremental revenues and incremental costs. They haven't yet occurred, so they're not sunk. They are avoidable if we decide to take just the money from as is. So they meet the definition of being relevant, and those two items will be used in our analysis. So I'm going to choose to list the revenues from processing, further processing, and they mentioned that if we further processed it, we could sell those for $80,000. And if we choose to do that, the cost for further processing would be $12,000. So if I choose that option, I'll call that my differential income from processing. Let me take the difference between those revenues and expenses by subtracting one from the other. So now we are looking at money coming in. So instead of looking at costs like we did on the previous two exercises with outflows, now we're looking at inflows. And so we're looking for the higher of the two. And so the best alternative between these two items would be $68,000 from processing. And so I'm going to call this net differential income. This is where you need to identify the decision, the correct decision, from, and I'm going to put it in caps, further processing. Having an issue typing today, actually many days. So let me take the difference between those two and show the user what would be the bottom line results. If we decided to process further, we would bring in $8,000 more than had we chosen to sell as is. Take a look at that and we'll go on to the next one. Okay, this is a scrap or a rework. If you read it carefully, you'll notice it sounds a lot or very similar to a scrap or process further, or sell as is or process further. So I'm going to let you take a look at this problem and try and solve it on your own after we read it together. It says a company has to decide between scrapping or reworking units that do not pass inspection. The company has 22,000 defective units that have already cost $132,000. Okay, again, take a look at every number and decide whether you think that's a relevant cost or an irrelevant or sunk cost. The units can be sold as scrap for $78,000. Okay, there's one option. Or they can spend $99,000 in the future, emphasizing hasn't been incurred yet. They can rework them for $99,000 and turn around and sell them for $180,000. Prepare a scrap or rework analysis and then define what the proper answer is. Pause the video and we'll come back and look at the solution. I bet you did a good job on this. The first line item I started out with was sold as scrap. That was easier, but you could have started with the other one as well. If we sold it as is, $78,000 would be our revenue. If we decided to rework it, we would compare the revenue from reworking of $187,000 to the extra cost of doing the rework, which was $99,000. We took the difference between the two. Again, this is money coming in, so the higher of the two alternatives would be the best answer. And if we look at these, the net differential income, or the difference between these two, totaled $10,000. And we want to make sure that in the last line, we tell the user what our decision is. So I bet you did a good job on this one. If not, go back and locate your mistake so that we don't repeat the mistake again. Awesome job. Let's go on to the next one. One of the topics that will come up in this chapter is whether a special offer, which means a price less than what we normally sell our goods for, is pitched at us from a potential customer. And so before we talk about that, most likely in day 2, we'll take a look at setting normal long-term selling prices. Pricing decisions are one of the most important decisions that managers will face. They can be also a difficult decision. They take lots of things into effect, including supply and demand, and they apply these concepts to either pricing for products or services. It's important to have a good understanding of how products can be or are priced. Your author does a pretty good job of describing a price taker versus a price setter. Because he does a good job of this in the text, I'm going to leave that out of our video discussion. Price setters generally have weak competition. The product is generally unique. It could be a branded product. There are high barriers to entry into the market. These types of entities use cost plus pricing. That's the example that you see on your PowerPoint slide. We'll do an exercise related to this, but it's important that you also understand what a price taker is. That usually happens when there's strong competition, products are not unique, or products are not branded necessarily, so there's low barriers to entry. And these usually use target pricing techniques. So understand the difference as you read through the chapter And we'll do a couple of exercises during the lecture to give you a little bit of practice. We'll start off by taking a look at a price setter. They use a cost plus approach. So as the overhead shows, we'll first determine the total cost per unit. Total cost, by its very nature, encompasses 100% of the cost of manufacturing a product. To that total cost, we add a dollar markup, and that's usually based on a percentage that, in this case, the author will have to provide to you. Once we calculate the markup and we add it to the total cost per unit, we come up with the selling price per unit. Of course, that would have to be compared to other products that are out there, to the laws of supplies and demand. We'd have to take a look at the competition, but that's generally how price setters calculate their selling price. On the opposite side of the spectrum is the target cost method. When competition is high, companies might be price takers and have little control in setting their own prices. In such cases, target costing, also known as target pricing, can be useful. It's almost as if we work backwards from a market-driven price to get the allowable cost and then adjust our operations in order to be within that set time frame. Most companies fall between these two polar ends of the spectrum. Also, make sure you review the variable cost method, which is used to create markups that cover both fixed costs plus the target profit. Again, read this section of the book, as we'll quickly do a couple of exercises related to setting normal selling prices, so that when we come back on day 2, we can talk about accepting special short-term selling prices. Okay, let's jump in and get our hands dirty and take a look at one of the problems that deals with setting a normal longer-term selling price. So it says Compro is designing a new smartphone. Each unit will require $285 of direct materials, $10 of direct labor, and it goes on and lists all these different costs: $30 of variable overhead, $5 of variable selling, general, and administrative, $14 of fixed overhead, and $16 of fixed selling, general, and administrative costs. And they want us to do 3 things. They want us to compute the selling price per unit if they used a total cost method approach. Okay, that one, as I noted down below in the solution that I've started, is most often used by price setters. And we defined earlier what types of companies would be considered a price setter. So what we want to do on number 1 is include every single one of those costs that's listed here. And then we'll be able to mark it up by 220%. This would be a company that doesn't have too much competition out there. And again, go refer to the author's definition of what a price setter is. So I'm looking at another screen so I can keep everything on one screen. The direct materials were $285. The direct labor was $10. This is all listed in the above requirements. The variable overhead was $30. The variable selling and administrative was another $5. The variable, let's see, did I miss one? Variable overhead, variable selling was $5. Then we had the fixed selling. Let me scroll down a little bit more. The 2 fixed costs that we have were $14 and $16. So when I add that up, 100% of the costs are included in the total cost approach. I get $360. The author told us to use a markup percentage of 220%. So I'll go down here and I'll compute the markup. And the way we do that is by taking that cost of $360 and multiplying it by 220%. That'll give us the markup of $792. That means that if we are considered a price setter, we can set our selling price at the cost plus the markup. In this case, that total selling price would be $11.52. Okay, number 2 says use the same data, but let's assume that we're using the target cost approach. This approach, we learned, would be taken by price takers. They don't have a whole lot of say in setting the price because the market dictates it. That means they have lots of competition. There's low barriers to entry into the market. Anyone can make the product that they're making. And so it's almost a backwards approach with starting at the estimated selling price and then backing out what our target profit is and coming up with a so-called cost that we need to work really hard to keep our product under. Many times this requires cost-cutting measures. Many times it requires lean principles of manufacturing. So again, they mentioned that the company is a price taker, and the expected selling price, which is usually dictated pretty much by the market, is $1,000. So I'm going to enter that sales price in as our starting point. And they mentioned that that was $1,000. And they say compute the target cost if the target profit is 60% of the selling price. So all we would have to do is consider the target let me get the right wording in here. Target profit, for the delay, of 60%. So we are going to take 60% of that $1,000. So let me multiply that out. You can probably do that in your head, but I'll go ahead and show it anyways. That means that our target cost is the difference between those two, meaning if the market will only accept $1,000 selling price and we need to make $600 on that to be profitable, that means we need to keep the cost of this product below the difference, which is $400. Okay, that's used by people on the price taker side. The variable cost approach is more of a middle of the spectrum type of an approach. And so in this case, we need to calculate our variable costs of making the product, and then we'll use the markup given. That markup will need to be enough to cover the fixed costs as well as the company's intended profit. So we're looking at all of the cost data given here, but we're only picking up the variable costs. So that would be direct materials, direct labor, variable overhead, and the variable SG&A, or selling, general, and administrative expense. In other words, we would leave the fixed costs out of this computation because our markup should be enough to cover both the fixed costs as well as the profit. So this would give us 285, 10, 30, and 5. Let me add that up. I'll call this total variable costs. We'll let the computer add it for us. Let me put a total line in there. Okay, now this markup needs to be 250% of the variable cost. So 250%, that means that this is going to be the $330 times the 250%. When I allow the computer to calculate that, we get a total cost, or actually I should call it a total selling price of the sum of those two. Okay, again, which one is taken by which company depends on how competitive they are and how volatile they are to the market competition and the supply and demand, the barriers of entry, and all those other things that you covered in your economics class. On to the next one. Okay, let's do one more make or buy problem. This one may have more than two alternatives, which is the reason I assigned it. It says Alto Company currently pays an outside supplier $4.50 per unit for a part. So option one is to continue to buy that part for $4.50. There is no correct order on how to present this. I tend to do the easier ones first. Let's keep reading. Alto is considering two alternative methods of making the part. Method one of making the part would require direct materials, which is always an incremental cost, direct labor, which is always an incremental cost, as well as just the incremental overhead. Okay, so we'll sum those three up. Making the part would be $1.20 for materials, $1.50 for the labor, and incremental overhead of $2. Let me go ahead and put a total line in. I'll go ahead and sum these up. So if they decide to make the part using the first method, the total cost would be $4.70. And then alternatively, if they decide to make the part, they could use a second method. So once again, we'll take a look at direct materials, direct labor, and incremental overhead. That was given at $1.20, $1, and $2.75. When we sum that up, sorry for the gardener suddenly appearing in the background. Sum that up, we'll get $4.95. So taking a look at all three of those options, it's clear that the cheapest option is to continue to buy the part. So on that number 2 requirement, go ahead and state what the actual decision is. The cheapest alternative is to buy the part. And if you wanted, you could quantify what the cost savings would be to continue to do that. On to the last one. We're almost there. Okay, great job of hanging in there. So this is our, I believe, first one of the day on special offer pricing. This is not a long-term decision like part of our lecture was today when we were looking at setting normal, longer-term product prices. This is about whether to accept a special one-time offer below what we normally sell our product for. So as I glance at this income statement, I see that the normal sales price is $4. Let's go ahead and take a look at the facts of the case at the bottom part of your Excel spreadsheet. As a potential customer offers to buy 50,000 units for $3 each. Okay, again, notice we normally sell our product for $4. These sales would not affect the company's sales through its normal channels. Okay, there are pricing laws in the United States, specifically the Robinson-Putnam Act, that need to be addressed, as well as you need to be really careful when you do something like this, that you don't tick off your current customers who are paying that $4. So just keep that in mind as we take a look at this. Details of the special offer follow. Direct materials cost would not change, always relevant. Direct labor would be 48 cents higher because they would have to pay overtime. Actually, not 48 cents higher, 48 cents in total. Okay, and if you look at that, that would be time and a half of the current 32 cents. And that makes sense because of overtime laws. Accepting the special offer would require incremental fixed general and administrative costs of $5,000. Okay, so whereas these gap fixed costs would not necessarily be relevant, we're focusing on incremental or differential costs. And so what they told us is there is a $5,000 fixed cost associated with accepting this. And then they make the statement that accepting the offer would require no incremental fixed overhead costs. All right, and of course the question is, should we expect or accept this special offer? So I'm going to look at the differential revenues first. This would be the revenue from special offer. And what they told us is that 50,000 units would be sold not at the $4 that we're currently getting, but at the $3. So that would bring in revenue of 150,000. Then we would take a look at the cost of making the units for this special offer. And again, there would have to be capacity. They didn't mention that, but there would have to be capacity in order for you to even consider making this. If you're fully booked up and you're selling all that you can make for $4, there would be no reason to consider this. But the author didn't mention it. There would have to be capacity to make the units, and they mentioned that they would not affect their other normal channels of sales. So here we would include the direct materials, the increased direct labor, the variable overhead, and then in addition to that, we would have that one-time fixed incremental cost of $5,000. So I'll probably split this up into the variable cost, and I'll put that fixed cost down here. That fixed cost, let me get it out of the way, would be $5,000. And these other variable costs, probably easiest to put in the per unit costs. And again, that overtime went up to 48 because of the overtime consideration. And the variable overhead would not change, so that would be 74 cents. So there are the per unit costs. Since we were told that we would be selling 50,000, I'll go ahead and take each one of those line items and multiply by 50,000. I'll copy that formula down here. And then when we add up our total incremental costs of making those units, let me title this total incremental costs. I'll add those up. We would take the difference between the revenue coming in and the cost that would be expended out, and I'm going to call that total net income from accepting the project. Again, although right now we are just filling in connect boxes on our homework because of this environment that we're in, you need to be able to prepare this analysis from scratch in the real world. And that would mean including what your final decision is in this last line item. So if we accept, I have trouble spitting out that word today, if we accept a special one-time offer, we would bring in an additional $20,000. And so considering only financial factors, that would be something we would consider doing. A little bit of a break, I think, for you on chapter 23. I think much of this, the concepts have been covered in other chapters, like the chapter where we spent time focusing on variable costs and fixed costs and how they behave differently. So I really don't expect the first part of this chapter to give you too much problems. If that's not the case, make sure you're reaching out either to your tutor or to myself, or attending the instructor lab hours offered several times throughout the week. I'll see you back for the second half as we continue on our journey.